This past weekend, Warren Buffett's Berkshire Hathaway reported a surge in their operating earnings, jumping around 20%, continued buybacks, and given that the stock is effectively flat this past year, certainly crushing the general indices that are down, double digits, around 20%. Here it is, Berkshire Hathaway stock flat, while fundamentals are increasing around 20%, at least their operating earnings. Does that mean Berkshire stock is now cheap? We'll talk about my thoughts around Berkshire stock, why I generally like it, but still think it could potentially go much lower in the months or quarters ahead. We'll talk about that dynamic in just a bit. First, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. Please make a point of hitting that thumbs up, hit that subscribe button if you enjoy watching educational investment videos. So let's understand, what's going on here? Well, first, yes, their operating earnings increased from $6.5 billion to $7.8 billion year over year, and from $20 billion to $24 billion for the first 9 months of the year. But their underlying investment portfolio and derivatives just completely overwhelmed in both periods, significantly causing book value of Berkshire to actually decline significantly. So in the most recent quarter, their loss on investments was $10 billion. Year to date, the loss was $65 billion. So year to date, a loss of $40 billion. So really, I'd argue an ugly change, but one should recognize this is mark to market. Do you really think there's been a permanent impairment in Berkshire Hathaway's portfolio? And when you're talking about Berkshire's portfolio, the largest bet by far is Apple, over a $100 billion position. That's around 40% of their stock portfolio. Other positions as well that are down: Bank of America, American Express. His oil bets have generally done much better, such as Chevron. Now it appears that his oil derivative plays are now effectively, the second largest position behind Apple. Some things have tied to, let's say, the financial sector, like Moody's or US Bank. They have been hit. And he also has, other bets that just, have not done extremely well. They've gotten hurt. Now, looking at what he's done year to date, he has become arguably a sizable buyer of stocks, becoming a net buyer of stocks. Last year, during the same period, the first 3 quarters of the year, he was actually a net seller of stocks. This year, he bought around $66 billion and sold around $17 billion. Bought $66 billion, sold $17 billion, net buyer of stocks, versus last year where he was a net seller of about $6 billion. And so that's looking at the investment portfolio. The question is, long term, do you really think that'll be impaired? I'm sort of skeptical. I think, Apple is a top position, and it's not necessarily cheap. It is an exceptional business, trading at a, somewhere around 20s something. It's been in a range of 20 to 30 times earnings. If there's a tough recession and consumer spending comes down, what's the possibility that re-rates to 15 and maybe even closer to a low teens like it traded at earlier this decade? So that is something to be mindful of, especially when that's a large part of Berkshire's portfolio. And that's part of the reason why I am cautious about Berkshire stock, and personally expect to see it lower in the quarters ahead, even though arguably it trades at a very reasonable valuation. We'll talk about that valuation. So let's talk about their operating earnings that increased by 20%, that everyone's so excited about. Oh, Berkshire, 20% earnings, underlying earnings growth if you ignore their portfolio. Well, folks, as always, especially with the Unrivaled Investing channel, you got to dive a little deeper. You can't just say 20%. I read the headline, huzzah, look how great this is. Let's actually dive in to understand what's doing this. Is this fantastic results, or is there something else here? Well, the reality is about 70% of this 20% gain, so the 70% of their operating earnings improvement, really comes from 2 different factors. One is gains on non-US dollar debt. Okay, so let me explain what that is. Gains on non-US dollar debt is effectively you issue debt. Berkshire issued debt in yen, issued debt in British pounds, issued debt in euros, and that debt in the foreign currencies is now worth less because the US dollar has appreciated so much. So they can say, oh, those liabilities that we have, we're going to effectively recognize a gain. Now, this is effectively a one-time gain based on the relative strength of the US dollar. So I look at this and I'm saying this is phony baloney, sort of saying, huzzah, 20% gain. But the reality is that was a huge contributor to, what you saw. They talked about $858 million in the third quarter due to non-US dollar denominated debt. You could see that's a big chunk of the difference here. The difference, their operating increased by, a little over $1 billion, around 1.2 billion that it increased by. And so you're saying, well, wait a second, this includes 858 million from non-US dollar denominated debt effectively being worth less because the US dollar appreciated. So that's an important point. The second point is that their insurance investment income has jumped significantly. And this is actually one of the points that I've been alluding to in several of my videos. One of my top holdings is a similar insurance company where if you have a prudently managed insurance company, which Berkshire is, and they have a prudently managed investment portfolio such that they don't have super long dated bonds, much shorter dated bonds, let's say 1 year, 2 year, 4 year, that haven't been crushed, because a lot of the longer dated bonds have gotten absolutely crushed, down like 30% this past year. What they're actually doing is they're now benefiting from higher interest rates. So all that cash that Berkshire's sitting on, now they're getting a higher yield on that, and that's directly flowing into their insurance investment income. I expect to see that number improve further in the quarters ahead. So you can see that's, like around 40% jump, a sizable jump, from 1.1 billion to 1.4 billion. So that's a big component of this 20% gain. So that I do give them credit for. However, I recognize that that's partially out of their control, largely out of their control. That's sort of the cash that they have, their short-term treasuries. What the Federal Reserve does in response to inflation will impact effectively where that is. If the Federal Reserve, if all of a sudden the economy were to crash and we were facing a depression, I'd argue that insurance investment income would decline significantly. Now, that, a component of that does come from dividends from some of the stocks that they own, but the jump is largely because of higher interest rates. So then that leaves that last component of like, well, what's actually driving this higher? And it's their effectively other controlled businesses. We'll talk about that in a second. But before talking about this third component, it is worth calling out that their results were actually really mixed. Insurance underwriting declined year over year, both in the quarter and year to date. So that is not great. Now, you did have some catastrophe, costs here, but that it is worth calling out that that's not great. Railroad, because of effectively a spike in energy prices and also labor costs, is lower year over year in the quarter. Then looking at, utilities did pretty reasonably, but really looking at this, it's these factors that I've already mentioned plus the controlled businesses. So let's talk about some of their other controlled businesses in terms of, what's driving this gain. And so when you're thinking about their other controlled businesses that are not utilities or railways or insurance, this is actually dozens and dozens and dozens of different businesses. And I can't go through all of them here. And I'd argue Berkshire Hathaway is sort of like a snapshot of the U.S. economy, because if there's something going really well, you'll see it, partly in the results. And if something starts blowing up, you'll start seeing that in the results as well. Now, arguably, it's like the U.S. economy plus, because it's arguably better businesses that they own, because Warren Buffett's an exceptional capital allocator, but still it is tied to the general economy. So let's talk about like some of these businesses that drove that that increase in operating earnings. Once again, it's not the biggest part of it that drove that improvement, but let's understand, well, you have industrial products, you have building products, you have consumer products, and you could see and they also, this is just manufacturing, they also have services that did well, but you could see okay, consumer products actually declined in the most recent quarter and year to date. So it's really actually building products that's the biggest driver here, that had a huge increase from 800 million in profit to 1.2 billion in profit. So it looks like building products is the key factor here. Well, what do they have to say about building products, talking about a nearly 50% increase in earnings, pre-tax earnings? Well, they talk about, broadly, we've benefited in recent years from low interest rate environment. However, interest rates in the U.S. increased significantly over the first 9 months of 2022. As a result, the significant increase in home mortgage interest rates has slowed demand for new home construction, effectively expecting comparative revenues and earnings in the near term will likely decline from current levels. So that, in my opinion, is a bit of a warning, effectively saying, this growth that we're posting don't expect that in the quarters ahead. And so that's why I'm looking at these results saying, yes, I do like higher investment income from effectively higher interest rates. The benefit from issuing debt in foreign currencies, that is just a reflection of Warren Buffett being super shrewd and saying, hey, if I can borrow Japanese yen at 1% or less, and and I can benefit from the strong US dollar, that's an example of him being super genius. And it's awesome what they can do. Not everyone can have that sort of access, but I also view that effectively as a one-time gain as well. I don't view that as a structural driver of growth going forward. And so I look at this and I'm sort of saying, well, it's very mixed. Effectively they're warning about their building product segment. Then another key aspect of why their operating earnings improved was they talk about one of their subsidiaries, Lubrizol, saying it increased $250 million in pre-tax earnings in the third quarter, which is actually largely due to insurance recoveries from a fire. So once again, one-time related benefits. They talk about how there was a gain of about $142 million in the quarter versus a sizable loss in the prior year in 2021, $73 million loss associated with it. So I look at this, and once again, I don't see this as super strong. I view this as a very mixed picture looking at their operating earnings. I think higher interest rates clearly benefiting them, but I think when you're looking at the economy, it's not like this business is actually growing at 20%. What you're really talking about is much lower rates than that. Now, if they're able to deliver, let's say high single digits, low teens going forward, that could still be a very satisfactory return for investors. So that is worth understanding. So the question is, well, where does Berkshire Hathaway stock even go from here? First, if you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. In full disclosure, this is not financial advice. And so thinking about Berkshire Hathaway stock, where does it go from here? Historically, the metric Buffett liked to use before he sort of changed it up, moved the goalposts in the last few years. Previously, he used price to book value. Now he's sort of saying, let's focus more on the earnings, the underlying earnings, the normalized earnings that this business generates. And so we'll talk about both components, but I still think, given that a huge part of their business is tied to their insurance operations and arguably this very sizable investment portfolio, $450 billion investment portfolio, that's going to drive their returns. So let's think about effectively two different approaches. One is price to book and one is sort of normalized earnings. When I look at price to book value around 1.4 times, historically, you go back for several decades past crises, you look at it and it typically bottoms around 1 times or a little less than that in terms of price to book value multiple. And so you even go back to the dot-com bubble. Before the dot-com bubble, it was trading at a low multiple like that. Great financial crisis, it got there. COVID, it got there. It wouldn't surprise me in the upcoming recession that I fully expect in the quarters ahead that you will see Berkshire potentially trade at that valuation. That is personally what I would expect, because if you have true economic recession, because the Fed tightens so much that they're saying, hey, we are going to do what it takes to crush inflation, do you get that recession? And if you get a recession, once again, because Buffett is, Buffett's Berkshire is exposed to dozens and dozens of businesses, you do see that sort of impact to the results. And then you do see that impact to valuation. So I would expect personally, if history is any sort of indication of what's historically happened and what could happen in the future, it wouldn't surprise me to see it trade back to around 1 times. So that is a point, an important point to consider, as you're thinking about where it is. Now let's consider it from the valuation of normalized earnings power. So what is the normalized earnings power for Berkshire? So they've got, once again, $460 billion portfolio, mostly in stocks, but they do also have, short-term treasuries, cash. Now, some of this cash, a large chunk of it, I think around $30 billion at a minimum, they're just going to keep effectively in cash on their balance sheet, just because effectively saying, hey, we want to be the trusted insurance company, reinsurance company around the world, so that people know no matter what happens, we have cash where we will be able to settle whatever the catastrophe is. They have the cash for it. So that is an important aspect when you're thinking about this business. But overall, $460 billion portfolio, what do you think Warren Buffett and his lieutenants, and he's hired some extremely brilliant investment managers, what do you think they'll be able to squeeze out of a 460 billion, let's round up, a $500 billion portfolio over time. I'm roughly penciling out $25 billion after tax. Now, you can sort of mix and match this, because keep in mind, their operating earnings that I was talking about earlier, that included effectively the interest income. So let's mix and match where we say, hey, that gets included here. So you're going to say a minimum, like 5% on 500, let's say $500 billion portfolio, that gets you to closer to 25 billion. But once again, that's pre-tax. So thinking about this, okay, maybe this is around 25 billion. Maybe you're going to say it's closer to 30 billion or 35 billion. So you get a ballpark figure for what this could be over time. There's going to be years where it goes down. I mean, year to date, it's down like $65 billion. It's going to be lumpy, but long term, from an earnings perspective, normalized earnings, you should probably think 25 billion, maybe 30 billion in earnings power from their underlying investment portfolio, stocks and bonds that they have. And so then the next component is what about the operating earnings? And, penciling out, if you exclude the interest income, the, insurance investment income that is effectively tied to the cash that they have. So let's attribute that to the first component. Then you're really talking around 25 billion, give or take 5 billion to their underlying operating earnings, and that includes, once again, dozens and dozens and dozens of different operations. And so you're all in talking about, maybe, somewhere between 50 and 60 billion dollars in normalized earnings for this business. And it's currently trading, the B shares are currently trading around 287. So that implies around $630 billion market cap for this business. So effectively, Buffett's Berkshire Hathaway is trading, 10 to 13 times normalized earnings for this. And so I look at this and I'm thinking that's actually very, very reasonable. I think it's going to be lumpy for Berkshire Hathaway shareholders. It'll be an occasional bumpy ride. You will have drawdowns, so you should expect that. That's part of the journey with investing, is that you're going to have bumps in the road. I personally would expect in the coming quarters to see a lower valuation, especially if you see the economy start to contract because of the monetary tightening from the Federal Reserve. And I, expect to see a further hit to their investment portfolio and operating earnings. That's personally what I would expect to see, especially relative to history, where it typically bottomed closer to 1 times book value. So we'll see. That said, over a, let's say, 5 to 10 year time frame, if you think Berkshire still has the management in place and the investment management in place to be able to grow their portfolio, grow their underlying earnings, I still look at this business and I'm thinking long term, they try to buy these best in class businesses. Maybe they grow high single digits over time, maybe low teens over time. And in case you're wondering, well, am I getting a good deal for that? Well, you're effectively paying a low teens multiple. So maybe that re-rates to a mid-teens, maybe even high teens, maybe it gets to 20 times multiple. So there is real possibility of generating significant returns over, let's say, a 5 to 10 year time frame. Like if you're able to get high single digit growth plus a re-rating in the valuation from, let's say, 11, 12, 10, 11, 12 to 15 to 20 times, you can get those dual growth engines, of both fundamental expansion as they take their, 30 billion in annual free cash flow, reinvested in the business, help them drive their growth. So this business, let's say, grows around 10% a year ballpark, and keep in mind, this is a hypothetical framework. The stock price can go way higher, way lower. It depends on the execution. So if they're able to deliver over, let's say, the next 5 to 10 years, around 10% growth, you have that growth driver. And then you have the second component of valuation, potential expansion, where maybe because folks start waking up and sort of saying, hey, this trades at 12 times normalized earnings, maybe it really should be 15, 20 times. Then you're really talking about maybe low teens to maybe even high teens annualized return over the next decade for Berkshire Hathaway stock. So I definitely see how Berkshire can outperform the major indices over the decade ahead. And that's personally why I do like Berkshire Hathaway stock. That said, my largest personal investment, I call this out to my Unrivaled Investing subscribers, is literally an insurance company with a similarly good track record with Berkshire, performing very high teens, results over a multi-decade perspective, yet it's trading at effectively at half the valuation, nearly half the valuation that Berkshire's trading at on a price to book value multiple. So that's personally what I want to see in this environment. I want that extra margin of safety, put that over my shoulder. I want that extra margin of safety when I'm buying what I think is in a very, very tough investment environment. I want to get that extra upside potential because with the Federal Reserve tightening, a lot of things aren't yet priced at that valuation that is typical for when you're in a recession, or is when, I'm hearing some reports like, oh, stocks are priced for a recession. I just so strongly disagree. Stocks, the reset that you've seen, I'd argue, is from higher interest rates, where people are saying, oh, wait a second, what do you value stocks when interest rates are now at 4 or 5%? That's very different from where we were a year ago. And now you're getting higher cash balances. I have a link to Interactive below where you can get, 3% plus on your cash balances. That's personally where I keep my investment accounts. So I look at this and I'm thinking, the reason why the stock market's down is valuation. We have not even yet really felt the impact. And even looking at Berkshire's results, they haven't even yet felt the impact of a true potential economic contraction from monetary tightening. If anything, so far they've benefited from, at least from an operating perspective, from the Federal Reserve tightening because their interest income is now higher. So if you enjoyed this video talking about Berkshire Hathaway stock, where do I think it goes in the years ahead? Where do I think it goes in the quarters ahead versus a 5 to 10 year time frame? Please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for watching Unrivaled Investing.